In many ways, the financial decisions you make in your 20s are more crucial than those you make at any other point in your life. The most crucial decision you can make is to get started right away. Consider two college grads who have access to tax-deferred investment accounts that earn 8% per year. The first investor saves $250 per month for 10 years, for a total of $30,000, then doesn't invest again for another 30 years. Their portfolio is worth $509,605 at the end of 40 years. For the first 10 years of the same 40-year span, the second investor does not invest. Instead, they will make a monthly contribution of $250 for the next 30 years, totaling $90,000. The second investor, however, although saving more money over a longer period of time, only ends up with $375,074. This demonstrates that the most powerful combination for wealth growth is time and compounding power. Time has the capacity to turn little habits into great results, whether you're saving early and often, gradually adding to your financial portfolio, or maintaining the course in times of uncertainty. With that in mind, these are the top activities you should do in your 20s. Number 1. Set objectives. It's crucial to know what you want to accomplish with the money you earn before you invest. A reverse budget is a useful tool for identifying goals and devising a strategy to achieve them. Short-term savings should be held in cash rather than invested in the stock market for goals that are less than 5 years away. Market volatility is unavoidable. It's the price of higher expected returns in stocks versus bonds or cash. Thus, accepting the risk of market losses for short-term aims is imprudent because they have less time, and often none, to recover. While cash should be used for short-term needs, a mix of stocks and bonds is required to develop your wealth for long-term goals such as retirement or paying for a child's college tuition. If you don't have enough riskier assets, such as equities, in your portfolio, you might not be able to accomplish your long-term objectives. A portfolio with insufficient risk will also necessitate an exaggerated savings rate in relation to cash flow. Before I continue, take a moment to like and subscribe if you find this content to be valuable. A lot of work goes into our videos, and we hope you watch to the very end. Number 2. Get the most out of your retirement accounts. There are several retirement accounts that allow wages, income, and capital gains to compound tax-free. Start by contributing enough to your employer-sponsored retirement plan to qualify for a match. If your employer matches 3% of your contributions and your annual salary is $100,000, you'll need to contribute at least $3,000 to your retirement plan to receive the entire match. It's like leaving free money on the table if you don't make this contribution. Once you've put enough money into your company's plan to get the match, focus on increasing your contributions to other tax-advantaged accounts in the following order: Roth IRA or deductible conventional IRA, workplace retirement plan, traditional non-deductible IRA, and taxable account. Finally, while a health savings account, HSA, isn't often thought of as a retirement account, it can be a unique method to improve your retirement savings. Number 3. Put money away for a rainy day. Regardless of your financial situation, having money set aside for unexpected needs is critical. In fact, putting some of your extra savings into an emergency fund takes precedence over making additional debt repayments or investing. An emergency fund should typically hold 3 to 12 months' worth of costs. If you're beginning from scratch with your emergency fund, set aside at least 10% of your monthly savings for it. You can probably construct this account more slowly if you have a good degree of job security and income predictability. To earn a greater interest rate on your emergency fund than you would in your normal checking account, consider saving it in an online account. Keeping your emergency savings separate from your main checking account also lessens the temptation to use those funds for non-emergency needs. Number 4. Do not attempt to outperform the market. Although investing is a complex activity, it does not necessitate a complex answer. The issue is that most investors get in their own way by tinkering in their portfolios needlessly. While it's natural to seek investments that outperform the market, most investors who go this route misjudge the level of competition and the likelihood of success. There is a mountain of evidence indicating both amateur and professional investors underperform the market on a regular basis, but it doesn't imply you shouldn't invest. Instead, it just recommends that using a passive investment approach will help you succeed. Number 5. Turn IT on automatic. As you become older, your finances tend to become more complicated. Putting your savings, payments, and investments on autopilot can help you save time and money. Automating a dollar cost averaging (DCA) plan for your investments eliminates the need to determine the ideal time to invest by contributing a defined amount to your portfolio on a regular basis. For example, on the 15th of each month, you may deposit $1,000 to an investing account for a long period of time. This allows you to diversify between asset classes as well as over time. Because you buy fewer shares when prices are high and more shares when prices are low, making equal dollar purchases over time can potentially lower your average purchase costs. While a lower average purchase price isn't always guaranteed, DCA is still beneficial from a behavioral standpoint because investing at regular intervals decreases the danger of buying at the wrong time and losing money right away. DCA is also the simplest option to invest on a monthly basis. You don't have to do anything other than set up monthly automatic payments to your accounts. Now is the time to start implementing these modifications. Early in life, excellent decisions will have more time to compound in your favor and put you on the road to financial success. So there you have it. Thank you for listening, and click on our next video for even more interesting and motivational economic and financial news. Watch all of our videos. We take pride in bringing you the very best. You may not agree with me completely, so let me know your thoughts. I am Mr. Smart Money, reminding you to stay smart with your money and to be excellent to each other. Watch our next video right now. I will see you in our next video.